Mastering financial statement analysis for strategic decision-making. The ability to interpret financial statements effectively remains one of the most crucial skills for accountants and finance professionals navigating today's dynamic business landscape. As global markets evolve rapidly and regulatory frameworks become increasingly intricate, mastering both the technical aspects of financial reporting and strategic implications is essential for driving organizational success. This comprehensive guide provides an in-depth exploration of financial statement fundamentals while offering actionable strategies for leveraging these reports to support informed decision-making across various professional contexts, from audit work and tax planning to investment analysis and corporate strategy formulation. Understanding key components of financial statements. A thorough grasp of fundamental components forms the bedrock of effective financial analysis. Core documents include balance sheets, income statements, cash flow statements, and equity changes statements, which collectively present a company's financial health through different lenses. Balance sheets offer snapshots of assets versus liabilities at specific points in time, revealing capital structures and liquidity positions. Meanwhile, income statements track revenues against expenses over defined periods, providing insight into profitability trends and cost management effectiveness. Cash flow statements bridge accounting profits with actual cash movements, distinguishing operating activities from investing/investment activities and financing activities. This separation is vital for assessing working capital needs and debt servicing capabilities accurately. Equity change statements illustrate how retained earnings accumulate or shrink due to net income distributions or share repurchases. These components form interconnected systems rather than isolated reports. Analytical rigor demands understanding interdependencies between them. Liquidity ratios, current ratio, current assets/current liabilities, helps gauge short-term obligation fulfillment capacity. Solvency indicators. Debt-to-equity ratios measure long-term viability by comparing borrowed funds to shareholder investments. Profitability metrics. Gross margin percentages indicate efficiency, converting sales into profits before overhead costs. Efficiency benchmarks. Inventory turnover rates assess asset utilization speed relative to industry norms. Best practices in preparing accurate financial statements. Maintaining accuracy and consistency during financial report preparation prevents costly misstatements that could lead to regulatory non-compliance penalties. Establishing clear internal controls and standardization protocols minimizes human error risks significantly. Evidence-based documentation becomes paramount. Source documents must always accompany entries supporting ledger balances. Implementing automated reconciliation tools helps detect discrepancies early through real-time comparisons between subsidiary records and general ledgers. Focusing on timeliness ensures stakeholders receive updated information promptly. While month-end closings require careful coordination among departments, establishing standardized timelines avoids delays impacting subsequent analytical processes. Precision in classification matters greatly. Improper categorizations distort performance evaluations. Assigning accounts consistently according to chart of accounts definitions maintains comparability across reporting periods, crucial for trend analysis. Rigorously testing assumptions behind estimates, like allowance for doubtful debts calculations, safeguards against optimistic bias influencing reported figures unduly. Documenting rationale for these judgments enables auditors to validate them later if necessary. Advanced techniques for analyzing financial data. Professionals seeking deeper insights beyond basic ratio analysis benefit from employing sophisticated evaluation methods. Trend analysis uncovers patterns spanning multiple periods, while comparative analysis highlights differences between entities operating similarly within industries. Trendline visualizations reveal whether revenue growth is accelerating/decelerating progressively over time. Identifying seasonal variations aids inventory management decisions in retail sectors where demand fluctuates predictably through annual cycles. DuPont analysis decomposes ROE into three factors: profit margin, asset turnover, and equity multiplier ratios. This breakdown isolates strengths/weaknesses influencing overall return on investment performances distinctly. Vertical and horizontal analyses allow benchmarking against industry averages. Expressing line items as percentages of total revenues normalizes scale disparities, enabling fair cross-company comparisons regardless of size differences. Segmented reporting adds another layer by disclosing geographical or product-specific contributions. Disclosing EBITDA margins segmented by region reveals regional performance variances worth investigating further if present. Common pitfalls to avoid when interpreting financial reports. Newcomers frequently overlook nuances in financial disclosures, leading to misleading interpretations. Assuming identical accounting policies apply universally neglects important variations affecting comparability across firms. Inconsistencies in depreciation methodologies, for instance, can skew net income appearances dramatically even among otherwise comparable companies choosing accelerated versus straight-line approaches. Failure to reconcile foreign currency translation adjustments distorts consolidated results artificially if not carefully considered. Likewise, understating provisions for contingent liabilities exposes firms unexpectedly during audits. Over-reliance solely on historical data ignores changing market conditions that may render past performance irrelevant for predicting future outcomes. Integrating qualitative assessments alongside quantitative metrics improves predictive validity substantially. Undervaluing intangible assets' impact on competitive advantage creates incomplete valuations. Failing to disclose research and development expenditures limits appreciation of potential future growth drivers significantly. Case studies demonstrating real-world applications analyzing well-documented cases illustrates practical applications of theoretical principles discussed earlier. Examining Enron's collapse offers cautionary tales regarding ethical lapses and opaque off-balance sheet arrangements. The Enron scandal revealed how creative accounting enabled manipulating perceptions of financial strength artificially. Their use of special-purpose entities hid massive losses away from ordinary shareholders until revelations erupted publicly. A contrasting example is Apple Incorporated's transparent disclosure practices fostering investor confidence despite intense scrutiny. Detailed explanations behind R&D investments help justify high current expenses against future expected gains clearly communicated upfront. Examining Warren Buffett's Berkshire Hathaway demonstrates how conservative accounting principles contribute long-term stability. Their reliance on tangible book values instead of market capitalizations reflects disciplined risk management approach. Comparative analyses between Amazon and Walmart show divergent reporting philosophies reflecting underlying operational models. One emphasizes GAAP compliance tightly whereas the other embraces broader stakeholder perspectives more freely. Leveraging technology in modern financial reporting automation streamlines repetitive tasks previously consuming significant manual effort hours. AI-powered platforms identify anomalies flagging possible fraud, proactively reducing exposure risks considerably. Cloud computing solutions enable seamless collaboration between geographically dispersed teams working simultaneously on shared documents without version control complications typical of traditional file sharing methods. Machine learning algorithms applied to historical datasets help predict probable earnings surprises ahead of scheduled releases, helping analysts adjust expectations preemptively rather than reactively. Blockchain technology introduces immutable transaction records, enhancing audit trails, vastly improving transparency levels unattainable manually maintained systems ever achieved historically. Virtual reality interfaces facilitate immersive walkthroughs of complex financial constructs, making abstract concepts accessible visually rather than relying purely text-based descriptions alone traditionally employed. Compliance and regulatory considerations. Adhering to evolving regulations protects organizations from legal repercussions while maintaining public trust. Keeping pace with updates to International Financial Reporting Standards, IFRS, and generally accepted accounting principles, GAAP, remains a critical challenge requiring constant vigilance. Recent developments include increased emphasis placed upon climate-related disclosures as sustainability concerns gain prominence globally, prompting new guidance being developed actively currently. Different jurisdictions impose varying requirements, complicating multinational operations, significantly necessitating expert knowledge discerning applicable mandates precisely per location served. Implementation of new lease accounting standards affects balance sheets, profoundly shifting rental obligations from footnotes onto primary statements, altering liquidity calculations fundamentally, thereby reshaping capital structure analyses. Securities Exchange Commission filings dictate stringent disclosure requirements mandating full transparency about executive compensation structures, ensuring alignment between leadership incentives and long-term shareholder interests safeguarded adequately. Future trends shaping financial statement preparation. Ongoing digital transformation promises revolutionizing how financial data gets captured, processed, stored, analyzed, utilized across enterprises globally tomorrow, compared to previous decades. Focused primarily paper-based records manually maintained. Artificial intelligence integration already beginning redefine roles performed daily by CPAs, including tax return processing, where machine learning models outperform humans regarding accuracy and speed demonstrated consistently now. Governance frameworks evolving continuously reflect growing awareness. Cybersecurity threats targeting sensitive financial information demanding robust protection mechanisms implemented urgently, addressing vulnerabilities exposed regularly. Increasing demand exists for ESG, environmental social governance, reporting aligning corporate activities with sustainable development goals measured systematically through standardized KPIs monitored routinely, internally, externally assessed periodically. Cross-border collaboration expected rise due globalization intensifying, requiring harmonization efforts among regulators toward convergent standards, easing complexities, managing multi-jurisdictional affairs successfully executed, effectively, cohesively everywhere involved ultimately. Conclusion: mastering the intricacies of financial statement analysis empowers professionals to drive meaningful outcomes across diverse functions within their organizations. From detecting inefficiencies to identifying growth opportunities, this skill set serves as cornerstone capability demanded repeatedly, irrespective specialization areas chosen, pursued diligently, continuously. To remain competitive amidst rapid technological advancement and regulatory complexity, invest ongoing education, updating competencies, continually embracing innovations emerging, constantly shaping future of profession, enthusiastically welcomed, eagerly adopted, widely adopted, enthusiastically wherever encountered, experienced, personally observed, firsthand, visibly witnessed, clearly documented, thoroughly researched, academically validated, empirically confirmed, scientifically proven, statistically verified, objectively measured, quantitatively analyzed, qualitatively evaluated, critically reviewed, independently verified, peer-reviewed, published, disseminated, circulated, shared, broadcasted, transmitted, exchanged, transferred, communicated, relayed, conveyed, transmitted.